Hello and welcome to this should be fairly short video on calculating how much you pay if your state has a graduated income tax. So today what we're going to do is talk about what a graduated income tax is and learn how to calculate how much money you're going to pay if you have to pay a graduated income tax. The definition of a graduated income tax is an income tax, just like state income tax that we learned about in the last video, but instead of one flat percentage that everyone pays, and that's your income tax, the tax rate that you pay increases with the amount of money that you make. Tax rate increases the more you make. So the idea here is that if you make more money, you should be financially able to pay more in your taxes, okay? And I want to just talk about this for a second because to some people this might seem, well, hold on a sec, that's not fair. You're punishing me for making more money. If you live in a state with a graduated income tax, they look at it from the other way. If you make more money, you are more able to help out the state and the rest of society by paying a little bit more for things like taxes, or excuse me, for things like schools, roads, police, fire, government, other things like that. And I think that's a fair trade-off. They're not taking, it's not that some people sometimes they say, well, you actually make less money if they're taking more. That's not true. You're still making, if you're going into the upper tax brackets, you're still making more money than someone who's making, well, someone who earns less from their job. It's just that a higher percentage of what you make ends up being taken. Your profits, your net income is still increasing, okay? It's still higher than it would be otherwise. So here's our formula to figure out the tax withheld per pay period. This is if we want to figure out how much money is being withheld, not for the entire year, but instead just for, let's say, how much in your weekly paycheck or your bi-weekly paycheck or whatever the case may be. If you want to figure out how much tax is withheld for each paycheck or each pay period, you take your annual tax withheld, how much tax you pay. Remember, tax withheld just means how much tax you pay for an entire year. Your annual tax withheld, how much you pay in an entire year, divide that by the number of pay periods per year. Okay, very similar to when we figured out how much money you made per pay period. In that case, we took our total that we were paid for the entire year, divided it by the number of pay periods. So if you got paid every month, divided it by 12. This is the same thing, except it's with taxes. So how much tax you have to pay for the entire year, divide that by how many pay periods, and you get how much tax you have to pay each pay period, each paycheck. We're just going to do one example of this. If you remember commissions from the first unit, then this is going to be fairly straightforward to you. It's a lot along the same lines. Louise Maffeo's annual salary is $34,500. She is paid semi-monthly. Let's underline that. Her personal exemptions total $1,500. How much does her employer deduct from each of Maffeo's semi-monthly paychecks for state income tax? So this is going to be a lot like state income tax with one exception. Instead of there just being one tax percentage or tax rate, there are multiple for the different levels of income you might have, and this is just an example. So in state income tax, the first thing we do is we find the taxable wages. That's your annual gross pay, how much you make in a year, minus personal exemptions. It says right here that Louise Maffeo's annual salary is $34,500. That's her annual gross pay. And her personal exemptions total $1,500. So to find the taxable wages, just like in the last video, we take the annual gross pay and subtract the personal exemptions to get the taxable income, which in this case is $33,000. Oh. Now, if we look at this chart, it tells us the rates at which different amounts of income are taxed. Up to $1,000, for the first $1,000 you make, the tax rate is 1.5%. Okay? Let's actually convert these to the decimals right now that they're going to use. 1.5 divided by 100, because remember that's what we do. That's going to end up being 0.015. 3% is going to end up being, remember we just divide by 100, 0.03. 4.5% is going to end up being 0.045, and 5% is going to be 0.05. Okay? So let's talk a little bit about how this works. Up to $1,000, you are taxed at a rate of 1.5%. So that means if you make anything under or up to $1,000, then that first $1,000 that you made is taxed like this. You take 1.5% of that $1,000. The easiest way to do this is take the gross pay and multiply by the tax rate. So $1,000 times 0.015, and that is $15. So on the first $1,000 that you make in your income, or that Louise makes in her case, she pays $15 in tax on that. 2, your next $2,000 that you make. So if you make above $1,000 and up to when you make $3,000 total for the year, the tax is 3%. So on the next $2,000 that Louise makes, that money is taxed at 3%. Notice that even though she makes very clearly much over all of these, it's basically just taking different parts of her income. Like the first $1,000 that she makes is taxed at this rate. The next $2,000 that she makes is taxed at that rate. So the next $2,000 that she makes, she's going to pay $60 in taxes on that money. Okay, so notice so far we've dealt with already $3,000 worth of her money. On the next $2,000 of that she makes, so that's from $3,000 to $5,000, she's taxed at 4.5%. So for another $2,000, she's taxed at 0.045, and she pays $90 in tax on that money that she makes. Now, that's usually pretty straightforward for most people. Here's where it gets a little tricky. You have to pay attention to that word over $5,000. That means anything that she makes in excess of $5,000 is taxed at a rate of 5%. Notice that we've already taken care of the first $5,000 of her income. $1,000, $2,000, $2,000. If I add those up, that's $5,000. Anything over $5,000 that she makes is taxed at 5%. We need to figure out how much money over $5,000 she makes. And we also have to remember that we're talking about the taxable income here, okay? That $1,500 in personal exemptions, that money is not taxed. So we're just dealing with the $33,000 in taxable wages. So first, we need to do $33,000, that's the taxable wages, minus the $5,000 that we've already dealt with. Okay, we've already taxed that first $5,000. That's where these numbers came from. And that is $28,000. That means she makes $28,000 that is taxed at 5%. Okay, so that's the rest of the money that she makes that's in taxable wages. So now we simply do $28,500. That's the remaining money of her taxable wages that hasn't been taxed yet. And that is taxed at 5%. She pays on that $28,000 $1,400 in taxes. So that's how much money she pays at each tax level. That's why it's called a graduated income tax. You're paying different tax rates for differing levels of income. Let's say she only made, let's say, $3,000. Well, then it would be all of the money that she's paying in taxes would be taken care of by just these first two levels. If she makes any more than $3,000 but less than $5,000, we're only dealing with these first three levels. But since she makes over $5,000 in taxable wages, we have to use every single level. And the last level is whatever's remaining after we clear up these first three levels. So we need to figure out how much tax was withheld in total. We do that by simply adding up the amounts of tax for all the different levels. So that's $1,400 plus $90 plus $60 plus $15. 1,400 plus 90 plus 60 plus 15. $1,565 in annual tax withheld. Okay, so each year she pays to the state $1,565 in income tax in this graduated income tax system. We want to know how much is withheld per pay period. It says she's paid semi-monthly, and if you remember, semi-monthly means 24 paychecks per year. So all we have to do is take 1,565, divide it by 24 for 24 paychecks in a year, and we get that she pays $65.21 in taxes per pay period in state income tax. Okay, that's the general idea with graduated income tax. It's different from state income tax only in that there are different percentages for different levels of income. Okay, and again, the reason for that is if you make more money, you can stand to pay a little bit more in taxes and still have everything that you need to survive. All right, we'll get some more examples and practice with graduated income tax soon. If you have any questions, please let me know, and I'll talk to you later when we come back for our next set of notes. Bye.